Hello, everyone. I hope that you're having a wonderful morning. My name is Roberts, and I'm the investment platform lead at Twino. And today with me here is Eduards, who's also a part of Twino team, and he's lead product designer. Uh, I believe that you are here because of our discussion or masterclass topic, which is how to become an investing genius. I mean, it's a very bold word probably, and I will be really honest with you. It's very unlikely that you will become a genius after this session, but we will try to guide you through some simple truths and simple rules that will help you with your investment journey if you decide to start one. And we really hope that you will. So here you can see our agenda for this masterclass. So we will start with a topic that is important to financial goal. So you will see some statistics and you will understand that putting a financial goal is a key. Then we'll move forwards with saving and investing, which is an interesting topic, and you will see some numbers that will really show the difference between those two things, because saving is great, but you will see that investing is even better. And the third topic is those 5 truths or rules that will show you, and we really hope that they will help with your investment journey. Now, here you can see a small quote on this topic. So only saving money for retirement is not enough. And it's something that we really believe in because, as I mentioned, saving is great, and it's something that you have to do because this discipline is key for any investor. But we believe that investing is even more important, and as I mentioned, we will show that with some good examples and statistics. Here, another important thing that I want to highlight at the very beginning is regarding the questions and answers, because this is a masterclass and we're trying to give the most important information for you. But if we miss something or you want to dive a bit deeper in some specific topics, we encourage you to go to Slido and to ask your questions. You can also use the Pine platform comments. We'll just gather all of the comments at the end of the session and try to address as many as we can.
All right. So we would like to open up with a question to you. And we would like to ask you, what's your age? So please go to Slido using the code that's visible on the screen. It's just a simple question where it will help us to tailor the presentation a bit further. While you log into Slido and post your response there, I want to expand why we are asking for that. And the reason is that the age is very, very important because the age that you are at now and the age that you want to retire, the difference between that is the amount of time that is actually left for you to ensure that your retirement is awesome. And of course, we would be much rather be spending time to be out there enjoying the day, probably on a beach somewhere, rather than think about retirement. But it's very, very important to think about it right now. I see from the Slido responses that most of us, almost 60%, are in the 30s. But there are people in the 20s and the 40s as well. And yeah, the range in the 30s is growing. So thanks for responding. And you can now think how much time there is between your current age and the age of 65. The 65 because it's the most kind of common retirement age in Europe as well. And you have to think about that right now so that you can actually plan for that. And by planning, we mean that you need to ask yourself, where do you live when you retire? What are your hobbies when you retire? How often do you go to vacations or trips abroad? when you retire. When we are in the 30s, it's a pretty hard question to answer. It's hard to predict the future, but quite simply, it means asking yourself, what quality of life do you want when you retire? And answer to that question, of course, would be more or less the same quality of life that we enjoy today when we are working full-time, 40 hours a week. But naturally, probably our income would be much different when we stop that 40-hour work week. So what we are going to talk next is about savings. We will share some numbers, but don't worry about them. We will explain why later.
Yeah. Moving forward to the next slide, we'll go through statistics, or at least something that Fidelity believes in. So it's one of the largest investment advisors worldwide, on how much money actually do you need saved by a certain amount, by a certain age in your life. So in this first example, you can see that if you're 30 years old, you need to have saved at least one annual salary. I don't know if you have that money in your bank account. You can think it by yourself, but that's a decent amount of money. Then the next, and the next, and the next, you can see that the amount of your saving is just growing. So here in the example, if you're 45 years old, you already need 4 salaries in your bank account. And then if we go to the 67, we see that you already need 10 times of your yearly salary in your bank account. I mean, it probably sounds like a lot, and it kind of is a lot, but we'll show you that by having the discipline, you can be there, even if you are by your 30s, don't have any money in your bank account, which also might be the case. And next on, I think we will show you a couple of examples. So as we saw that most of you are in your 30s, so this example can probably resonate to you. So if you're 35 years old, you also need to keep in mind what's your salary, because as I mentioned in the previous example, your lifestyle and your salary goes hand in hand. And if well, at least here on the left side, you can see that if your salary, for example, is 3,000 euros, then you should have saved already 72,000 euros. While if your salary is 5,000 euros after tax on a monthly basis, then you already need 120,000 in your bank account. Next example, if you are in 50s or 15 years after the first age group, then these amounts, of course, increase, and they increase quite a lot. If we compare maybe these age groups, then by the age of 35, if your monthly salary was 5,000 euros, you had to save 120,000. Now, in this example, if your salary is 2,000, which is more than twice, less than 2 times, then you also need 120,000 in your bank account. So 15 years, but with really quite significantly lower salary, you already need the same amount in your bank account. And now I give the floor back to Edwards, and he will show you some statistics of what actually is happening in the world.
Yes, thanks, Robert. That's what we should do to save multiple times our annual salary. And the benefit, of course, is that with that savings, we can better react to the unexpected things in our life. But the reality, of course, is that certain part of us actually don't have the savings available, which means that if there is unexpected expense, like car breaking down, or there's an emergency trip required to somewhere, more often than not, this makes us to borrow, to cut down on the spending a lot to recover those expenses, because only 39%, according to this study from Bankrate, actually can use the savings for those emergency purposes. And naturally, the primary way how we actually create the savings is through saving certain part of our monthly salary And the reality again here is not perfect as such, that still almost a third of us in general in Europe do not put any money on a regular basis aside for these savings for emergency expenses and so on. What's also interesting is that only less than half of people save 10% or less, and that's quite small part of the salary. But it's better to save at least something. And further on, again, don't worry about this. If you're in your 30s, there's still 35 years of time left actually to build the savings and to establish your ideal retirement plan. So don't stress about it, of course, too much. You have to have a very cool head when it comes to finances. And you have to understand what numbers are you comfortable with. You have to set your milestones for the savings, both on a monthly basis. So you need to ask yourself, what percentage of my current month's income I can actually put aside in another bank account or some savings product or so on that you're comfortable with. It could be 5, it could be 10. In certain cases, people go as high as 50% of the monthly income. And you need to then do some simple math to forecast how much money would you save in a year, in 5 years. And through that, you can already see what that would mean for you if you start planning your family or going ahead to the retirement. It would show you what would be your savings amounts there. And lastly, of course, you just need to start. Starting is one of the simplest ways. You can just right now do the first step and go and start saving and investing. But yeah, so we have talked about saving and importance of saving. But of course, the topic of today's masterclass is investing. And investing is what enables you to have a much better result, because if we look at the difference, what does it mean in practice? We can see this example right here, where a person is actually putting a solid amount of money every month in the savings account of 500 euros. And over a period of 30 years, those savings have grown to around 180,000 euros. Which is nice. You can probably buy an apartment somewhere with that money. But it also means that that by only saving money, you're actually missing a much bigger opportunity. Because if we take the same person who is putting aside 500 euros per month and investing that money immediately every month with an industry average return rate of 10%, in this example, of course, this varies. The person that is investing rather than only saving has accumulated over 1 million in the savings account, and the difference is huge.
Yeah, and now I hope that you see that there are definitely benefits of investing. And here I will guide you through the most common approaches of investing, and we are splitting it in 2 parts. So the first one is active investment, which, as the words say, is something that you do quite actively. And the passive way is the other way around. You still invest, but you don't probably allocate that much time for that. But let's start with the active investment. So what does it mean? It's really quite a hands-on approach, because what you have to do, you have to spend quite a lot of time by understanding which stocks to buy or other instruments. You just have to do your due diligence on the matter, and you have to spend those hours probably on a daily basis, because you are there for the returns. And that's the biggest difference between the active and the passive way. I would say at least it's the time and the potential of return. So active way is taking quite a lot of time, but then again, you have the opportunity to earn more because you're actively participating in the market and you are in a constant battle to basically win the market, which definitely is not easy, but if you get lucky or you are really good, you can do that and achieve higher returns than market averages. Another kind of important thing that you are acting like a portfolio manager. So you have your portfolio of investments and you are managing that on a constant basis. It's rather time consuming, but as I mentioned, the goal is to be the stock market and to achieve higher than average returns. The second way is passive investment. So as here as well, the words say, it's more passive approach. So what you do, you invest for the long haul. So say you are not ready maybe to spend many hours on the investments on a weekly basis. And that's why you are going for this way, which means that you are putting the money aside and you're constantly investing in some instruments that I will tell you about later that don't ask for that much attention. You also have to be kind of psychologically ready for this because this approach really means that you have to limit your inner voice that will say to buy or sell. You shouldn't act on any of those voices that want to give you some directions on what to do, because it's always important to stay in the market, to don't react on what is happening in the markets, because it will change with the time. There is fluctuations, so the prices change, but you should just sit down. And this is the mentality that you need to have. So buy and hold for the long haul. Lower fees because you don't trade that much, you don't buy and sell all the time. So of course there's lower fees if we look in total. And the goal is to keep those market average returns. Now, going a bit deeper in active investment and taking a look of what kind of typical investments would that mean. So it's maybe not just about the type of investments, it's more of an approach, but typically if you want to actively invest, you would go for some individual stocks, hopefully quite many, but still individual, and then follow them on a monthly or weekly or daily basis and try to buy and sell at the best possible time. There's also an instrument called CFD, which are contracts for difference, but in their essence they're quite similar to stocks because they, in most of the cases, they mirror stocks or other financial instruments, and you get paid if the value of this instrument rises or falls, and that's why they are contracts for difference, as the word difference says. And the last one that I want to mention is, of course, cryptocurrency, which is quite hot topic nowadays, but the market, of course, is very volatile, so the prices change quite often, and that's something that you have to keep in mind if you decide to go in this market. To take a look on a couple of examples maybe, so what can happen to you if you go in this active approach? So it might happen that you have Tesla stock in your portfolio, which would mean that if Elon Musk comments or tweets something, then that might impact your returns directly. So that's something that you have to be ready for, but it might go each way. So you can also get some wonderful returns if you were, for example, an early investor in Dogecoin, which is a quite common or popular cryptocurrency in the markets nowadays. Well, the passive investment approach are typically looking for instruments that gather multiple stocks or any kind of different financial instruments, but the idea is that you get quite a lot of stocks together, you put them in a fund or index, and then you as an investor have basically multiple stocks in your portfolio, and you are quite safe if one particular stock falls in value. So there are multiple kinds of exchange traded funds or index funds that you can choose from. There's also peer-to-peer lending that we at Twino are doing. So it's also a passive investment. So you lend your money basically to invest. Well, you as an investor lend your money to borrowers in multiple markets, and you don't have to act that actively. In this case, you're just passively doing that with some automatization tools. Some good quotes maybe to keep in mind from passive investment gurus such as Warren Buffett is, if your salary is your only source of income, you're one step away from poverty. And the other one is from his colleague Charlie Munger. So if you don't have to be brilliant, only a little bit wiser than the other guys on average for a long period of time.
All right. It sounds a lot, I know. So please remember that you can ask questions about things in general related to savings and investing, and about some specific investment types and products. We have plenty of time left at the end of the session to answer those questions, so keep them coming. But you might also be thinking, okay, it's super hard, right, to make your decisions, make up your mind, to pick the stocks, pick the funds, and so on. But there's this nice study that we just couldn't share about monkeys throwing darts on a piece of newspaper with certain financial pages open. So through that throwing of a dart, the monkey picked the stock to invest in, and thus creating a portfolio of hand-picked stocks. This portfolio was then compared to a portfolio that was created by an expert who was very highly skilled in picking the right companies to invest in. And surprisingly, the results of these portfolios compared were pretty similar. The experts didn't do much better than the monkeys. And well, it's kind of maybe a funny thing, because the darts are of course thrown in random by a monkey, but well, good job. But it doesn't mean that we should just go ahead and pick random stocks in alphabetical order or what else. It just shows that it's very hard actually to outsmart experts. So it's much better for the beginner, and we are really considering beginning of investing here, to invest in the market as a whole rather than to pick stocks to make certain bets. So you might not be kind of very eager to start, but there are still some things that you should know before you actually start investing if you haven't done already. First, you have to pick a strategy. That is the baseline. We will expand more on the details later in the 5 rules that we will provide. But picking a strategy means that you make a plan. You understand how much time do you have? Is it 20 or 30 or 40 years? And you understand what risk are you ready to take. Because if you're younger, you can take a bit more risk, because there's a lot more time to recover from the losses if it happens. If you're closer to retirement age, you just don't have the opportunity to risk the retirement savings. So it all affects the strategy that you choose. And it's important for beginners to pick a balanced strategy, because going all in on something is probably not the smartest idea in the long term. So we always recommend to mix active and passive investments to get the best benefits.
Yeah, and here we are coming to our rules. So the first one is start saving early. So hopefully today, or even better if you have done it already in the past. But to kind of illustrate that a little bit better, we have here 2 personas, so a sister and a brother. And here, both of them have the same starting point, I would say, apart from one very important factor, which is time. But other than that, they both start with 10,000 euros and add 500 euros on a monthly basis. So on the chart, you can see that a sister, which in this company is the smart one, starts at the age of 30, while the brother, which is also quite smart because he at least starts at the age of 40. The difference is 10 years, and on the chart you can see the difference that goes through the age of 65 or the potential retirement age. So the sister has saved more than 60,000 than the brother, which is a very solid sum. But the most important thing that I want to illustrate with the next slide is that there's also a huge difference between saving and investing. And you can see it also in this example. So here, the same personas, the same amount of money, with the only difference being that both of them start not only saving, but also investing. So both of them still started at the same age, with the same capital of 10,000 euros and additional 500 euros each month. But the difference in this time scale is huge. So the brother ends up with nearly 800,000 euros, which is great, and probably also achieves the goal that we mentioned at the very beginning of having 10x salary after this period of time. But the sister is definitely crushing him in this case, as she has saved and earned more than 1.5 million euro more than the brother, only because of the fact that she started 10 years earlier.
Yes, what I like about that example is that the difference of 60,000 euros actually gets more significant when we look at the investing example, because there it grows. And I hope that alone is enough for you to convince to consider investing, because, well, that's just a nice number to see, of course. But if you're ready to start, we also would like to make this rule, rule number 2, that you have to start with small but also smart steps. And with that we mean that you need to define your milestones, as mentioned before. You need to have a goal in mind, and you need to work towards that goal in a certain way. So take a moment after the session to imagine what you would need for the retirement or any milestone. Sooner than that, let's say in 5 years, and try to work out what would be the number that you need to save, invest, how much risk you can take, and so on. But investing, of course, is more difficult than just making a transfer to your bank account, because at the end of the day, you have to make a decision, and you have to make informed decisions about investments you do. So you have to read, you have to understand how things work in investment area, and what does it actually mean to be a shareholder of a public company. And that is because you should only invest in investments that you understand. Is it stocks, crypto, peer-to-peer lending, and so on. If you can understand it, you can actually more or less guess what will happen in certain situations, and there would be less surprises for you. So really, it's important to understand and to pick only investments that you understand. But you also need to be disciplined, because you have set your milestones, you have made your plan, you need to stick to it. And ideally, you need to establish what we might call as financial hygiene, that you invest or save regularly on a monthly basis, and you stick to that plan, regardless what happens. Because it's for the long term much better to stick to the plan rather than be very spontaneous and buy something just because you find it interesting. And the next, of course, real rule is about costs and the fees. Because investing, of course, is a transaction, and that is what you do when you get investment services from somewhere, either buying stocks or anything. And those transactions involve fees, either 0.5%, 1.5%. They are kind of small percentages, but really the thing there is that that means a lot, because even if they appear very similar, and in the short term it doesn't mean much, But if you look at the long term, we can again take the brother and the sister's example, where the sister was smarter. She was very kind of deliberate of what she invests in. She chose more the passive investments. That actually means that the fees are lower. So the sister's portfolio has only 0.5% fee per year, while the brother who was playing the catch-up game, because as you remember, the brother started later, decided to be more aggressive, to pay an advisor 1.5% per year to manage his portfolio. While on average, the kind of the returns are balanced, it means that the brother has not only kind of started later, been more aggressive, took more risk, chose expensive products, investments, meaning that he's kind of in a worse position, because not only that, but he also has paid almost 120,000 euros more just in the 25-year period than his sister. And that is the money that could be in his bank account, in the savings account still. So what we would like to say to you is that you have to watch out to those fees. You have to find them when you make investment research and when you pick your investment partners. And you have to think how those fees will affect your portfolio in the long term. They won't mean much in a year's time, but if you account for the whole 30-year period, they will add up. And also you need to follow changes in the fees in the market, because they will change. Because as we know, in the financial services industry, things are becoming more and more open, so there are a lot more possibilities to invest in nowadays than it was before. So at any time, there may be another opportunity waiting for you.
So going next is rule number 4, which is regarding the diversification, which is a very complex word at the very beginning, but actually the idea behind that is quite straightforward. So you shouldn't put your money or your funds at the same thing. Like, don't take all of your money and then put it in one particular stock, because some things might go wrong with that company. Something might really impact it quite badly. Either those are business results or some public news that comes out regarding the reputation of the company, and your whole savings or investments can then crush down. And that's the whole idea behind the word diversification, that you take your money, you spread it around between multiple stocks or multiple investment assets, which might be you take 20%, put it in some index fund, then another 20% in some bunch of stocks that you really like, then you go to peer-to-peer lending, crypto, and so on. So if you have many industries in your investment portfolio, you will be more safe when something goes wrong in the world. It doesn't mean that you're completely safe, of course. If there are global crises that we saw last year or back in 2008, you still will be impacted, but the impact will be not that worse, and it will be not because of one particular thing. It will be because of general news or happenings worldwide, which is fine, and it will even out in the years to come after the crisis has passed. And going back to Eduards with the last, but definitely not the least rule.
Yeah, and that is the rule about tuning out the noise, because diversification is important, but also it's important to stick to your plans. Investing in itself is very dynamic, so you can have apps open on your phone that show you the daily changes in real time, seeing the arrows go up and down in green or red. So it's a very nice thing to watch and to observe. It's like a sport almost to some. But the thing is that, of course, the market will always go up or down or sideways. So that's only basically the 3 outcomes that you can expect in any market. And there's so much news about that. So there are articles online, there are blogs, podcasts. Everyone has their own opinion about what will be the next big thing. And at the same time, of course, there is what we cannot avoid, crisis in the economy, pandemics, things like that that actually affect the market in a very, very huge way. And after those crises, you might actually be very emotional because you see the portfolio going down. But the emotions are, you should be careful with emotions, because smart investors do not put emotions as basis for investment decisions, either for buying or for selling investments. And as an example, if you have sold your portfolio after the crisis of 2008, it would mean that you would not actually get the gains that happened in the next 10 years. And it's important to keep this in mind, that you have to be patient, because it's not for the short term. It's what our message really is, that it's for the long term, right? And last thing that we would like to also remind you is to understand your biases. And with that we mean that there might be this new thing coming up that everyone's getting on, supporting the idea of a company or a cryptocurrency or anything. And you might be seeing in the news articles that that investment is growing and growing. So you might experience the emotion, fear of missing out, FOMO. And it's another thing that you should avoid, because more or less it's much more riskier to follow that emotion than to make a very rational decision to put your money in certain investment. But at the same time, well, of course, we have to kind of describe diversification and long-term planning and thinking. But naturally, there are things we are passionate about, either an industry or a product or a company or an ideology of something that is open and available to all and so on. And we might be tempted actually to pick certain investments, to make riskier investments. And of course, that is totally fine, because through that you express your passion and you express your values, and you make a bet basically on something. But really the thing there is that we would recommend you limiting the amount of your portfolio that you use for those riskier investments that are not maybe diversified, that are not long-term, who knows. And as a rule of thumb, you should start with, you should not start, but you should limit that amount to 2 to 3% of the portfolio, so that if things go bad, you're not wiped out.
Yeah. But yeah, again, it all really depends on your age. If you're like really, really young, 20s or 30s, you can maybe increase a bit that part, but we wouldn't really recommend to go over 10%, because that would be probably too wild for anyone. But to summarize what we have talked about, so we have named 5, at least to our opinion, most important rules that you should follow if you want to be successful and knowledgeable about this topic of investments. Of course, there's so many literature out there and so many things that you could read additionally, and you probably should if you want to take these things to the next level. But to go through the rules that we already named, so the first one, start saving early, today. So these are the things that we are sure that are the most important, because if you don't save, you can't invest. The next thing is regarding the small but smart steps. So you can start with quite small amounts. Okay, in our examples, we had 10,000 euros and 500 euros every month. So maybe that's quite a lot for you, but it shouldn't be a problem. You can save a lot smaller amounts of money and you will still make a decent retirement fund. You can play around with these numbers. There are many calculators out there online. We have one on our Twino website as well. So you can check out your actual savings and your actual monthly savings that you can add to that and see what it adds up in the long haul. Rule number 3, keep costs low. Always pay attention to the websites or the brokers where you invest to be sure that the costs or the fees, commissions are not extremely high, and you will lose quite a lot in the longer term. Rule number 4, diversify, because one stock or one particular industry might disappear. We have seen that in the past quite a lot, so that's extremely important thing to keep in mind, because if you're investing in the long term, then some industries might disappear. So that's why we really recommend to diversify your portfolio with different assets, different industries, and then you should be fine. Rule number 5, tune out the noise, because that's world and you can't really escape the crisis that we all will have, and it's almost impossible to time them perfectly, so it's quite unlikely that you will manage to sell your portfolio in time or buy at the best possible time ever. So it's very important that you just stay calm, don't react to everything what's happening in the news and in the market, and just keep to your plan and continue to invest. That's it about the rules, and we can move forwards to the questions if you have any. So as we said, we encourage you to ask your questions in Slido. If you want to ask some questions later on, you can just contact us also to Twino. So just write to info@twino.eu, and we'll do our best to answer your questions as well. But I will give the floor to Edwards so he can start with the question section.
All right. Yeah, we actually got quite many questions already, 11. So cool. Let's start with the ones that are the most upvoted, and let's go through one by one. I will start asking Robert the first one. Which should be a solid target of return for a beginner?
Yeah, for the beginners, I would just go to the typical 10% that we mentioned previously. The key reason for that, if you are a beginner, I would say that just start with the first step, start saving, do some research on investments that you're interested in, and then start investing. Because it's quite unlikely that you'll be so great at investing and you will have quite a lot of natural talents that you will beat the market all the time. And well, at least that's the past. Past is showing that it's quite hard to time the market. And that's why I would go for the diversification, so some exchange traded funds. Just Google what are those things, what are the most interesting for you. So a bunch of companies put together, and you can see also, well, check the charts in the past, you will see that on average it will generate around 10% return for you. So I would aim for a number like this, not to try crush those 100% in your first months of investment.
Thanks. Good answer. I see also comments about the stream. So I hope everything is fine technically, but we will continue with the questions. We will continue with the questions, and there's another good one about saving and investing. So what's the ratio? How much should I actually put in savings? How much investing?
Well, there's no perfect answer for this. It's quite common that people are recommended to put aside at least 10% of their manual monthly salary, and that would be something that most of the people can do. But it really depends on your individual situation. So the difference between the saving and investing is that if you have invested funds, then there might be a case that you need this money as soon as possible. And sometimes there are some fees for withdrawing your funds. So in this case, I would also recommend that you at least have, say, one monthly salary available in your bank account. So in cash that you can take out if some emergency happens in your life. As Edwards mentioned, that's a thing that happens in people's lives, and if people are not ready for that, you will be affected because you might need to take a loan from the bank, use a credit card, take from friends and family. So either those are emotionally negative things or negative financially. So always keep at least some emergency funds, but all the other funds I would recommend to stick to the plan, invest, and just as Edward said, it's always good to have those recurring payments because it will keep you disciplined, and you will not even have to be disciplined in this case because it will just happen automatically and you might even forget about that.
Yeah, exactly. I will take the next question to Roberts about investing in peer-to-peer, actually. Probably a lot of our investors are watching the stream as well. And the question is why investing in peer-to-peer via Twino would be a better decision than investing in peer-to-peer via 5 times larger marketplace platform like Mintos?
Okay, it's a good question. Well, at least what I think, I don't know if my opinion is the best in this case because I'm working at Twino, but to put emotions aside, I think that there's the key difference between Twino and Mintos. The fact is in our business module. So in the case of Twino, we are offering only loans from only the lending companies that are our daughter companies or related companies to Twino Group. So we know all of them by heart. We are in constant contact with them. So all of those players that are available on Twino Marketplace or Twino platform are really related to us, which give us some control of what's happening, and we are always up to date on the news in all of the markets that we operate in because we actually are there with our teams. And from our Riga headquarters, we are also helping each of those markets with a certain specialties. So, for example, we have finance team in the headquarters, marketing team, communications team, and so on. So we can be in constant contact with them. Well, on the Mintos platform, you have marketplace. So there are many lending companies there from different shareholders, from different countries. So they have to be in contact with them and manage multiple, I would say, shareholders, multiple people that are behind those companies. So it's a different approach. In this comparison, of course, in this case, it's easier to have basically multiple loan originators because you don't have actually to lend the money, as in the Twino case, because we are also lending those loans in those markets. But in the Mintos case, they just have to be in touch and cooperation or business relationship with those loan originators. So I would say that that's the key difference. Other than that, I think that the returns are pretty similar in the peer-to-peer lending market. So on average, it's around 10%. But the key difference is what I mentioned earlier.
Yep. I will take the next question from Pine chat. And I will also try to give my impression. Roberts, please expand as you see needed. And
Sure.
The question is, what is the best ratio between different investment types, ETFs, stocks, peer-to-peer, and other? And of course, my take would be that you need to diversify your portfolio. You should not invest all eggs in the same basket. But also you need to evaluate how much time you actually want to spend to follow up on the portfolio. Because the broader the portfolio, the more time it will take to understand what's going on. In general, what we see is that majority of the portfolio usually actually goes into ETFs, around 50%, because that is kind of a passive investment type. Same with peer-to-peer. That's another type of a passive investment. So actually, significant part of investors choose to keep the majority of portfolio a passive investment. And the rest can go to more active investments like stocks through different kind of funds or so on. But again, it's important to diversify, not only by the investment type, but also by region, industry, because things are changing in the market. If you're investing all in the technology, you're risking that the technology will evolve. And it's important to diversify also across the actual companies and not really to put everything in the same area. Do you have something to add?
Yeah, I think those are great points. Another thing is that we have mentioned a couple of times already in this presentation is you have to understand how old are you. If you're in the early 20s or 30s, it's not a problem. You will have like 30 years or maybe even 40 years till retirement, so you have a lot of time to make mistakes. You can go for a bit higher risk, and it probably is recommended because you can achieve higher returns on average. While if you're already in your 50s or 60s, you should probably slow down a bit in terms of investments. You should still invest, but you should go for some index funds that are really diversified all over the world, or even try some other investment vehicles that might be some bonds or something that just has a lower risk, so it will not change in value that much, which is extremely important if your retirement is in, say, 10 years, because you don't want to have the situation when crisis hits and at this time you wanted to go in retirement. So I think that those are exactly the most important things.
Yep, exactly. Right, next question from Slido. Please feel free to add your other questions as well. We have 10 minutes left in the masterclass, so we are eager to know what are the most important questions in your mind. But this one also kind of continues the starting, and the question is where to begin, and actually how much time it takes to get comfortable with investing. What's your take on that?
Yeah, I mean, it's a very good question. I would say that you start with saving. So you start with the discipline to put the money aside because it won't disappear. It will be in your account and it will be available. Then the next step is to start study. Just to study what is investments, because we gave you a brief overview, but I mean, 1 hour is too less to go in really much details. So just study what's happening, just go and understand the ideologies behind the investment, because as we mentioned, there's an active approach, passive approach. Understand how many hours do you have actually in the week to spend to this whole investment thing. If you understand that you're extremely busy, then probably the easiest way is just find a good investment broker, send your money over there and invest once a month when your current payment arrives in this account. So that might be the easiest way. However, if you have like, I don't know, 10 hours or something on a weekly basis available, then you can also check on some active approaches, try out some just try out and then research some stocks or industries that you really believe in. So maybe something in green energy, maybe something in technology. It really depends on your interests, because if you're reading about these companies, you of course are also learning, and if the industry is not interesting for you, then it's very unlikely that you will keep on reading the news and be in the loop, and you will lose the interest with time. So I think that those are the most important things to understand. How much time do you have, and to start save as soon as possible.
Yeah, exactly. And I will combine this with another question, and there is about what are the risks for beginners. And naturally, there are some risks, of course, with investing, and you need to understand how much risk you want to take. But in general, the risks, of course, involve many things, like that you need to access the investment in a very fast way. Just in case, right? So the risk is that you might actually have to sell the investment on unfavorable terms, either because of the market situation or because of certain fees that the broker might put on the investment or so on. So you need to understand if that's a risk for you. It's, of course, less of a risk if you have the certain amount of savings readily available, so you don't have to sell your investment when it's not a good time. Are there any other risks?
I mean, it's maybe not a risk, but the thing that you probably should keep in mind is the emotional factor of these investments, because at the very beginning, people get very emotional about things that happen, because that's their money, hard-earned money, so they go to work every day, they work really hard, then they invest, say, 500 euros, and the market drops. So the feeling is quite bad, and that's something you have to be ready for if you're going into the investments actively. So if your mindset is to buy and sell, and you want to trade on a daily basis, you have to be ready for those emotions, and that's why I would really recommend to at least try it out. Try it out with a small amount, which is small amount for you, that you are ready, maybe not to fully lose, but to lose to some extent, like 50% or 20% of that by going in some individual stocks, and then just see how it feels for you, because it might be that in the first days you will constantly check your mobile phone and the specific applications to see what is happening. And if it's not for you, then go for the passive approach and try to forget about that something is happening in the markets. Just put aside the money and invest it passively, and just zoom out all of the emotions that come with the investment.
Yeah, and I would add also that you can minimize your mistakes by doing less transactions at the very beginning, so that you actually feel more comfortable and build up the attitude towards investing in risk over time. And it could be a month or a year. It's a really personal thing, of course. Right, we are 5 minutes until the end, and I see some other questions about Twino. Do you plan to offer wider investment opportunities besides peer-to-peer lending?
It's a good question, and currently we are in licensing process, so we are going for this investment brokerage license that we have mentioned in the past. We haven't had at the very early stage of our company, because we kind of started with other market players, completely new industry, which is peer-to-peer lending. So we have been in this process of developing new regulation or adapting to existing one. In the end of the day, we are in the final steps of getting this brokerage license, which also opens a door for us for other investment opportunities, and that's something that we are eager to take. We are looking already now on how to expand our offering with other types of investments. So as you know, currently we are only in peer-to-peer lending and in real estate, so you can also invest in some real estate projects on our platform, but we'll add also other kind of investments that will go in the direction of honestly our presentation today maybe as well, because there will be opportunities to buy some stocks or other type of investments, but we'll communicate that on that quite soon, and it will go together with most of our licensing communications. So just read our newsletters and read news about us, and you will definitely hear more about this topic.
Right. Nice. Maybe some of the very last questions before we end the masterclass about our own personal attitude towards investing and about our philosophy. What was our return in 2020? I can start, and of course the last year was actually quite interesting in regards to investing, because there was a significant drop of 20 to 30% in the market, in the stock market, in the March. And since then it has just like grown like crazy. But of course, that's the same for all. My personal philosophy is that I want to be very deliberate with saving 15% of my salary and my other income. So that's my kind of a rule. I try to do it the same day when I receive the salary, a notification in my phone, and I just transfer it to the investment account immediately. And I choose to invest very passively. So I buy ETFs most of the time, but around 20% are actually stocks that I have picked because I like technology. I want to support the ideas, and I want to be part of the green energy movement and support solar and everything like that. But of course, the return is different, because the average return for this passive approach is, as mentioned before, around 10%, 7 to 10%, depending how you measure. So my expectation is to keep that market average anyway. What's your take?
Yeah, It's a good question. I also try to save quite heavily. In the last year or something, I'm trying to put aside at least 30-40% of my salary, which might sound like a lot, but I believe that it's very important to start early and to put this money aside. And then, depending on the market conditions, I try to invest in some like larger type of investments, which would be those ETFs or something that gives the diversification. I also like real estate industry, so I'm looking for some opportunities there. If there's an apartment for rent-to-let approach, which is you buy an apartment and then you rent it out for individuals. I also am quite interested in investments and technology. So to be honest, I of course have traded or bought some more riskier investments in 2020. Which were some individual stocks. I've also bought those meme stocks, which were really popular this year. And I've also been in cryptocurrency, which I found really interesting industry for myself. But you have to be safe out there because the industry is really fluctuating a lot, so the prices are changing, and just today you can see that Bitcoin is dropping. So if you're invested in Bitcoin or any other cryptocurrency, you're probably seeing red screens all over your computer or smartphone. So I'm trying a lot of things around, but I think that the most important thing is just to have the discipline to start saving and put the money aside, and then you have at least the ability to try those approaches, to try the active approach if that is for you, or to go full on passively if you're not involved in investments that much.
Yeah, actually I noticed that we forgot to mention peer-to-peer lending, because maybe for us it's like natural, right, of course, and it's so easy to automate it. For example, I forgot about my portfolio that just like transfer and it's invested automatically. Yeah, but I guess that wraps up. We are at the very last minute of our time. I would say thank you very much for listening, and I hope you got interesting thoughts from this and something useful.
Yeah. If you have any other questions, as I mentioned in the past, you can write an email to us, to our info@twino.eu, and those questions will be passed to me or Edwards, and we'll try to address them as soon as possible. So other than that, thank you very much for watching. We really hope that it was useful for you, and have fun out there in the investments. Thank you very much for watching.
Thank you.